So hi everyone, welcome to this webinar, right? And this webinar, we are going to discuss mostly about careers in credit risk analytics. So we are going to not deep dive, to be honest. We are going to have a bird eye view of things, how a typical day of a credit risk analyst or manager looks like, what are different topics, different tools and techniques that a person in credit risk domain deals with, right? And for the same, we have today with us Peru. So I am calling him Peru, like he's Perumal Jack Kumar, right? So, but since I've known him for quite some time, so that's how we call him, back in EY. So we know each other from EY. So that was my second job. I worked there for quite some time, 3.5 years, and we used to know each other very well. And Peru is actually very senior to me, and he has extensive experience of over 20 plus years, and he has worked with several firms EY, Genpact, and Goldman Sachs, to say the least. So these are some of the few firms, and then he has worked on several credit risk models and provided several trainings as well. So he has been closely associated with both academia and then industrial experience alike, right? So I hope we will learn a lot of the things from his rich experience in this webinar. And with that said, I would just pass the stage to Peru so that he can continue and lead the stage from there.
Yeah. Thank you so much, Pratik, for having me here and also for the kind words. And yeah, it's good to see you, okay, sharing your knowledge with this emerging risk community, right? And to all of you, so like Pratik mentioned, okay, I've got like 20 plus years of experience. I've worked across model development, okay. I started with model development during start of my career, and then okay, I worked across second line in terms of model validation, a lot of regulatory aspects, CCAR, Basel, and so on. And then recently, I've also worked on third line, right? Okay, so which is on the model risk audit as well. Yeah. So I hope I'll be able to okay share in terms of okay perspectives from my experience, and I keep hearing from a lot of my students where currently I'm taking a fintech course as well, because many of them want to know what are the different career opportunities in terms of risk. So that's where okay, when Pratik and me were chatting, both of us had a common agenda where we realized when we were all working, we never had so much of okay information available for you to okay, pick up all this, right? Because a lot of it was on the job, okay, depending on the projects you get assigned. But I think yeah, so you guys are getting these opportunities, yeah, so do feel free to okay leverage this and let us know if there are any places okay where we could help. Yeah, having said that, so this session, okay, we're going to keep it the way I've structured is. So we'll have the career opportunities, etc. I'll kind of okay give you a bird's eye view and a holistic top view in terms of what are the different career opportunities, primarily from a credit risk analytics perspective, right? And obviously, okay, a lot of it you would also be able to leverage in your market risk, liquidity risk, and other areas as well. Yeah, and then a bit of overview given. I think the audience would be a bit of mix, right? Pratik, are we planning to run those poll, or okay, can we have people to put on their chat window just in terms of how many years of experience they have, and if any of them are already working in credit risk? If people could just answer these so that we get a sense of.
So yeah, Perus, I checked right before this session, and then there's some issues with this version of app, and I've been communicating with the Graphi team. So for this time, this particular webinar, unfortunately, will not be able to run polls, but we can
Sure,
ask people in the chat, right?
chat, yeah, sure.
Yeah, so that feel free. And one more suggestion I have, Perus, is if you can maximize the screen,
Okay,
if you
sure,
can
I'll do
run
that. Okay. Yeah,
that.
so let me just do that. Okay, is this better? Yeah.
Yeah, this is better.
Sure. So, Pratik, I'm on full screen. I'll not be able to see the chat messages and so on. Yeah, but you can keep me posted, okay? If I need to
Okay,
pause
cool.
anyway,
Sure.
right? Okay. So, thank you all for joining on a Saturday evening, right? So that means it shows the kind of interest you have in terms of shaping up your career in credit risk analytics. Yeah. So I'm sure, okay, all of us keep seeing lot of job posts in terms of, and keeping it specific towards, okay, more on, okay, banking, financial service, risk, and analytics area, right? Yeah. And I was also looking at some of those job descriptions and so on. And I'm going to, next slide, we're going to show live some of the ones on LinkedIn, Naukri, and others you see, right? But at a high level, right? Okay. So given there could be a mix of people who are here, yeah. So generally, in terms of careers in credit risk, so it's where so when I was with FICO and others, right? So we had titles like analytics scientists and so on, right? Okay, and then later consultant, senior consultant, lead consultant, so on, yeah. And a lot of other places, okay, you could join as a fraud or a risk analyst, right? Or some people join specifically as a SAS programmer, right? Okay, data analyst or functional analyst, or kind of, okay, credit scorecard developer. Yeah. So there are a lot of different titles which exist. And so these are some of the actual live openings which I saw on web in terms of social media, right? And you see a lot of the big global banks who have their global captive centers. So they keep posting a lot of opportunities in this area, right? So as I mentioned, in terms of risk management, we call it as like three lines of defense. And across these three lines of defense, so generally, okay, you got variety of job openings, right, across experience levels and so on. So some of the examples which you see here, right? Lead for a model risk management, right? I'm sure, okay, so here maybe the experience level will be a little bit more higher, but so this is on the second line, right? Okay, in terms of model risk management, yeah. So and then there are a lot of roles even for people who are starting, or okay, less than 2 to 3 years, where a lot of roles as risk analysts, right? Yeah. And then fraud risk analyst, right? Okay. And if you see here, there is a job opening from City which says credit risk analytics, collections and recovery. Yeah. So we're going to look at, okay, a lot of a bit of specific in terms of these domain areas, and similarly how you can position yourself, right? Okay, with the right mix of the finance risk knowledge with the technology and the analytics kind of, okay, expertise which you can develop. Yeah. So with this, at least here, I want to hear from you guys in terms of from chat. How many of you work in credit risk modeling, right? Okay. Are you working in your first line? That's where, okay, if you're doing model development, that is your first line. So if you're working on model validation, that is generally called second line, right? Or MRM. And third line is, okay, your internal audit or a model risk audit. And beyond this as well, right? Okay, there is a lot of other areas in terms of credit where so people could work on credit strategy, right? Okay, so this is where, okay, a lot of interesting things on credit line increase, decrease, and okay, a lot of analytics gets involved. A lot of people in the front office banks, and okay, so people work on credit policy side, right? And then in terms of loan pricing, in terms of, okay, how do you price the interest for, okay, like various products of loans and others. And from a regulatory aspect, like I mentioned, okay, so a lot of work on Basel model development, right? And then from an IFRS 9 accounting standard, a lot of work opens up on expected credit loss, or from an US perspective, it is called US ECL, or expected credit loss, current expected credit loss, ECL. And there is stress testing, okay, which we'll discuss in detail. So this is where, okay, I joined EY in 2015, okay, when CCAR was just starting, right? I went to US and so on, and okay, we set up the CCAR team, right? So there's a lot of work on CCAR and DFA stress testing. And I also want to set those disclaimers that so currently, okay, even though I've got like 20 plus of years of experience, but I'm going to share with you all more generic ones and nothing specific to, okay, any of the organizations I've worked on, right? So these are more personal, and okay, just want to share with you all. Yeah. So with that, just want to check. Yeah, I'm just checking the chat window. Okay, Kailash, you're working on model validation. Sashikant, okay, so you're doing your master's in economics, great. Preparing for your FRM, awesome, right? Shamla, okay, you're asking about people working in Indian banking sector. So anything specific in Indian banking sector, Shamla, right? What do you do? Which LOD do you work? Okay, that's Pratik has asked this. So you finish your college, currently working in Cement in operational excellence. Awesome. Yeah. So some of you have experience in liquidity risk. Some of you have, okay, like 8 plus years. Great. Uh, awesome. Yeah. So I think, see, that's exactly the objective, right? I know we got mix of people. Okay, some of you are already, Shamla, you're in forex and credit, right? Okay, yeah. See, Shamla, I'm assuming that, okay, you are more on, in terms of from a bank perspective, right? Okay, you're working on the forex and credit exposures, right? In terms of a bank perspective. So there will be a lot of people, okay, who might be on the bank side, they may be in the back office side, okay, or some of them might be working in sales and so on. Some of you want to transition into this credit risk analytics side of the world, is where, okay, I want to show you some how you can do that, what is the path, right? Because it's a very interesting field. And so when I started, okay, like 15 years back, okay, jumped into some of these, right? Obviously, like a lot of you, I didn't have that much of a guidance, right? So whereas now there is a lot of information available, I think that's exactly where, okay, between Pratik and me and others, right? Okay, we also want to ensure that we kind of give you some of the live hands-on experience, okay, which we have gone through, right? Not just, okay, from your chat gpts of the world, right? Okay, with due regards. Yeah, got it. So great. Pratik, is my pace okay? Is my audio okay? Just checking.
Yes, yes. To me, it seems perfectly fine. If you know, if anyone else in the chat, participants, like if they have any issues or with the pace
Sure.
or videos,
Yeah.
they can let drop like.
Yeah. So do let me know and put in your questions on the chat. And given I'll be in full screen, right? Okay. So I'll kind of, okay, pause in between, come back, or we'll take a lot of these Q&A at the end. Yeah. So just hold on, right? See, and again, this is just more at a very high level overview, at a flare across all these different areas. I know some of you who are experienced in, okay, you might already know on others, right? So just bear with us, because given we have got a different set of audience, right? Okay, we just wanted to give the overall view and the landscape of across credit risk analytics. Yeah. So having said that, okay, so let me move on. Yeah, so now the question, okay, for some of you who want to, okay, get into this interesting field of, okay, credit risk analytics, right? So I think that's where it's at a beautiful intersection of these three areas, right? So either some of you are already working with a bank, right? Okay, so which means you got like a very good domain finance knowledge, you might have a good risk knowledge and others, right? Yeah. So if you have that, right, okay, if you are able to, okay, we are going to touch upon some of the tools which are used here, right? Yeah, there is a lot of low or no code environment as well which has come in, but okay, so at least little bit of, okay, a lot of data exploration, modeling and others would also come in, right? Okay, yeah. So you also need to, okay, learn some of these tools, right? And similarly from an analytics perspective, right? Okay, as long as you have got a very good analytical mind, and okay, you are able to convert some of these risk business problems into an analytical problem, right? Okay, I think you would do well, right? Okay, so in summary, uh, yeah, you need to have a very good balance across all these areas, right? If you have one, so that's exactly where, okay, you can kind of see how you can equip yourself in some of these other areas, right? So now we'll be briefly touching upon in terms of what is credit risk, some of the basics, okay, and what kind of regulatory work which is being done here. Yeah. And again, okay, if some of you are already aware about it, right? Okay, so just kind of, okay, be open and listen in, right? But yeah, I also want others to get a broader view. But I'm happy to, okay, take some of the questions, okay, as we go along. So these are some of the key sources of risk, right? So you got like credit risk, market risk, ops risk, liquidity, interest rate, concentration. Yeah, and again, okay, there could be different classifications. Lot of sub classifications are there, but this is at a very very high level, right? Okay, so I think that's where our focus today, right? Okay, is going to be on credit risk. Even though I've worked on credit risk projects, okay, but again, I've worked on a lot of market risk projects as well. And similarly, I've built like a liquidity coverage ratio calculator, worked on an operational risk project. Because if you are in risk, you would start working on, okay, a lot of cross areas as well. Okay, so that's exactly where it's good to be aware. Yeah. But having said that, today's session we'll be focusing more on because this itself is an ocean, so we'll be looking on the credit risk aspects. So just for basics, just for starters, right? What does credit risk? Yeah. So if a person, in this example, Tony, he purchases a car, right? Okay, for 120K, and then okay, it takes a loan at okay for 100K, right? Okay, at 20% per annum. Yeah. So what would the bank do, right? Yeah. So they're going to do an underwriting. So that's where okay, before originating a loan, the bank is going to do a lot of risk management check, right? So at a very simple level, right? Lot of fintechs and others have come in, right? So that's where now there is a lot of data available. You got your credit bureau data, right? Okay, I worked in FICO, who were the pioneers in terms of okay building the bureau scores, etc., which is used worldwide, right? Yeah. In India, you got your CIBIL, right? Okay. So bank is going to leverage that, and there is a lot of alternate data which has come in, right? Okay. But in essence, what are they trying to do is trying to assess like the five C's, right? Because the fundamentals still remain the same, but here they're trying to look at, is this person a high credit risk or a low credit risk? Okay, and then depending on it, either they're going to approve the loan or they're going to reject. Yeah, but these are the things which earlier it used to be done manually and others, but like right now with all the advent of okay analytics technology and others is where all of this gets done, and okay just with a push of a button where the credit score gets generated, okay, and a decision gets done, right? Yeah. And similarly, okay, even how much of interest to be priced, okay, or what could be their credit card limit and others, okay, there is a lot of math, science, and functional experience begin which goes into this, right? So that's exactly where okay, if some of you are analytical and then okay you love numbers, you want to work on it, but at the same time you love finance, you love risk, right? Okay, so then these are things for you, right? Yeah. And again overall, right? Okay, as you know, you got like a banking book and a trading book, right? Yeah. So what are the sources of credit risk? Most of it okay it comes on the banking book side, even though uh, there's this counterparty credit risk. So Pratik had recently okay posted on LinkedIn as well, right, on SACR, which is standardized approach for counterparty credit risk. Yeah. So this comes on the trading book side of the world, right? Whereas the banking book side, okay, this is predominantly right, okay, your retail consumer credit risk, right? Right, if in case you're applying for a loan, you're applying for a home loan, right? Okay, so these are places where okay all your retail related credit risk comes in. Whereas on the corporate side is where okay you got like organizations where okay like a Crisil or a Moody's and others, right? They kind of okay similarly okay rate and come up with okay like all those different A plus, triple A plus, and others in terms of different SMEs and okay like properties or project financing and others. uh, Again, I'll pause if there are there any questions. Okay, great. I'll keep moving on. Yeah. So now we're coming into the overall customer credit life cycle. So like I highlighted, okay, in this loan example, so when a new person comes to the bank, so that's where we call it as origination of a loan, right? So here is where what is a business problem for the bank is they need to approve the good or low risk customers and reject the bad or high risk customers, right? And then extend lower loan amount or lower credit limit to risky customers so that you are able to cover your risk at the same time, right? Okay, you are able to charge higher interest rate to risky customers. So that is in terms of when someone is going to come into origination stage itself, because if you're able to weed out any of these rotten apples, then your portfolio is going to look good. Yeah. But once you are already in the system, that's when banks need to manage these customers. Okay, they could do a lot of cross selling, upselling, and so on, right? Okay, so that's where okay there is a lot of account management, right? Okay, how do they manage the limit of the customers? Okay, how do they keep any early warning signs and others, right? Yeah, we're going to see what kind of analytical tools or scorecards, etc., which is being built across all these areas. And then the end of the life cycle is where okay in terms of payments, right? Because that's the bread and butter for anyone, right? Okay, banks or financial institutions. So they need to ensure that okay they are able to get the principal and interest back from these customers, right? So if in case some of them are going to default and others, that's exactly where there is going to be a lot of loss, and okay like then it's going to impact in terms of your capital, okay, your provisions, and okay in terms of okay from a regulatory aspect. That's exactly where banks and others, okay, need to leverage a lot of analytical tools, which is collections and okay, recovery scorecards and so on. So that's what is there in this slide, which is so in terms of originations, we build something called application scorecard, or it's called acquisition scoring. And similarly, the objectives are different. If you want to identify whether a particular customer is a fraudulent customer or not, then you got okay, like tools and techniques to do fraud scoring, right? And then similarly, okay, you can have like different targeted scoring, or if a particular customer you want to predict at the start itself if he's going to get bankrupt or not. Yeah, so you can have a lot of okay, different things based on your objective. And then during account management as well, like I mentioned, right, because this is the period where okay, your customers who are going to stay with you, you want to minimize churn. So that's where we build a lot of things called behavior score, right? So here is where you use a lot of internal banks data, right? And then okay, right, and then you kind of okay, come up with this behavior score, and you will leverage that score from a strategy perspective in terms of limit setting, limit increase or decrease, okay, or kind of okay, predicting whether if someone is going to churn or not. Yeah. And like I mentioned, okay, collections, recoveries, and write-off. Again, these are very, very critical and important. That's exactly where, okay. Lot of okay. When I used to travel to a lot of APAC banks, we used to build a lot of collection scorecards. Okay, right. So there are early stage collection scorecards, late stage collection scorecards, and then once someone crosses those stage, okay, they come. We build like the recovery scorecards to see at least how much percentage we can recover from them. Yeah, got it. So now again, okay, a lot of it again I've taken it from public information. Okay, so FICO, as I mentioned, okay, they are the pioneers in terms of credit scoring, and when I had the opportunity to work with them, okay, traveled across APAC, where we used to do a lot of consultancy for a lot of these clients, right? So you got a lot of opportunities there, and the same thing is what, okay, you can look at from a TransUnion CIBIL score perspective, right? So if we see um, even okay, some of you can okay, go and check what is your score, right? So if you see in terms of your score, generally it lies between 300 to 800, but higher the score, obviously, okay, you're a better customer. But do you all know, okay, what all goes into, okay, right, in terms of these scores, right? Yeah, so even though it's a secret sauce, but at a high level, there are these food group elements which are available in public domain, right? So a lot of it, okay, comes from your payment history, right? Okay, and 30% comes from the amount you owe across your different lines, okay, across for different banks and so on, right? And then similarly, how long do you have a credit history, right? Okay, how much are you hungry in terms of if you keep on applying for okay, multiple loans and others, okay, so then the bureau and others will be able to track that, and okay, you will get penalized for it, right? And similarly, how are you using your type of credit, right? How much of unsecured credit versus secured credit versus a revolving credit you are leveraging. Yeah, so there is a lot of okay, functional and business acumen, okay, and analytics goes into this. So that's exactly where it also needs a lot of people like you guys who could start as an analyst, or okay, or like a manager, okay, or like a model validator or an auditor, right? Okay, because again the key is across the world, if you see, the regulators are very, very okay, strict, right? Okay, as you all know, after the financial crisis and others, so you had this Basel Accord which came from the Swiss city of Basel, but the key was they came up with okay, all these minimum capital requirements and okay, the entire three pillar process, right? But the key was for you to determine okay, what is your RWA, which is your risk weighted assets, and from a credit risk perspective, right? Okay, either some of the smaller banks, etc., used to get what are these metrics as a standardized approach from these regulators, or whenever okay, you were an advanced bank or a globally systematic important bank, right, which is where me and Pratik, okay, we have worked across for okay, a lot of these banks across in our experience, right? Yeah, so a lot of them used to use this AARB modeling, where you'll be kind of okay, predicting your Basel probability of default, exposure at default, and loss given default. Yeah, and similarly, okay, for your market risk, ops risk, others, okay, there are different models which are used. Yeah, so again, given each of these banks needs to comply with all this, they need to rerun these models and so on, right? That's exactly where you will always have okay, enough amount of work. And there is always this joke, okay, again I'm saying it from my personal experience, right? Don't quote me. So as long as okay, right, you got a regulators who are expecting things. So you will always have a lot of work for consultants and okay analysts, because there will always be changes which regulators are asking. As you know, Basel is now coming with the Basel Endgame, right? So again, it's at a NPR, which is a proposal stage. So which means okay, again, a lot of these banks have to revisit all their models and others, right? So that means there are a lot of opportunities which comes in, right? So again, okay, some of this are a little bit technical, and again, okay, I still wanted to give you all the flavor, but if any of you are keen, okay, we can have some deep dive sessions, or some of you could connect with me, okay, on LinkedIn, or okay, or I'll share my email ID, or with Pratik as well, right? Yeah. So in terms of PD, yeah, so what is PD? It's a very simple thing. In terms of, let's say you got like 1,000 customers in your bank for your credit cards, right? So of which, how much percentage of customers you expect that okay they're going to default? See, no one wants anyone, none of the bank would want anyone to default, right? Yeah. But irrespective of like all these scores and others, right, with all the, but still there are people, okay, who are going to okay miss. They may have a job loss, or okay they may have other economic situation, or maybe they're a fraudulent customer, okay. So some of them might default, yeah. But they, that is the beauty of risk, right? How are you mitigating it, okay, or how are you estimating so that you can have a backup plan, right? Okay, in terms of for these future contingencies. And the time at which okay someone is going to default, right? Okay, if we are able to predict and know that okay what would be the exposure, okay, of the portfolio at the default, okay, so that is your EAD, right? So again, okay, so that is your EAD. And then, so let's say one of this customer like Tony, right? Okay, he taken a 100K loan, but let's say after 6 months he had defaulted. But at that point in time, he had the amount which was lying was 75K. That was the exposure. It paid off 25K. So then that is your exposure, right? But not all the amount, okay, the bank is going to get, right? Right. So let's say if in case he has taken an auto loan, then the bank would hypothecate the automobile, right? So you'll be able to sell that back. Or if it is a mortgage loan, again you will auction it, but again the process will take some time. So then you have time value of money and a lot of other factors. But then so that's what okay we're looking at from a loss given default. So of the 75K, how much would the bank be able to recover, and how much would be the losses, right? Okay. So again, we do a lot of complex modeling in terms of determining your LGD percentage. So in summary, in layman's term, the product of all this PD cross EAD cross LGD is your expected loss, right? So mainly for your expected loss is where you use your reserves or provisions, which is what you will see in your PNL. So now that I've been speaking, right? Okay. So I want to ask you guys, okay, can you put on chat window? So this is for expected loss. We'll use provisions or reserves. How does the bank take care for unexpected losses? Because suddenly, okay, like the way COVID happened, or okay, there could be extraordinary scenarios, right? For unexpected losses, how does the bank take care? Yeah, Pon Shankar, what is CW? Capital, yeah, exactly, right, yeah. So this is exactly where, right, okay, the capital which the bank pumps in, okay, the equity and okay, the kind of okay capital which they keep in. So that is what is going to okay save them from any of these unexpected losses. That's what we are going to see in our next slide, right? So in terms of PD, AD, and LGD, again, taken a mortgage example, right? For each of these, while we are modeling and others, there'll be unique factors which you are going to consider for when you model a PD, okay, versus an LGD versus an EAD, right? Because EAD is an amount variable, right? Okay, right? LGD, okay, even though we are doing it as a percentage, but here we're going to look at lot from your loss perspective, whereas PD we're going to look at from a lot of borrower characteristics, right? Yeah. Yeah, so I think here is where it okay, like some of you rightly told, right? So expected loss, okay, is something which you will be able to okay cover it through your provisions and okay reserves, right? Yeah. Whereas unexpected loss, okay, I think that's exactly where all this modeling and others which we are doing is where if you are able to predict okay this entire unexpected loss, right? And again, okay, it's a you're trying to do it based on a probability and others. So that's where okay it shows this 99 percentile loss distribution. So this is what the bank would set aside from their minimum capital requirements. Okay, it's going to help them cover these unexpected losses. Yeah. Yeah. And again, right, okay, post your 2008 financial crisis and others, yeah. So that's when Basel came in, okay. Your Federal Reserve Bank, and then similarly, okay, your EBA, PRA, right, okay, APRA, right, okay, your RBI, right, okay. So everyone, okay, started looking at, they started getting stringent, and that's exactly one thing which people realized is it's like normal, right, okay. And some of you are students, or okay, or like some of you are in college, right, we all understand, right. When you are just in a class and others, okay, we are all in a normal stage, right. But let's say you're writing your exams, right, okay, so that's exactly where, okay, you have to do a night out, okay, or you are like at your utmost severe stress tested, right, yeah. So how do you, okay, come successful out of this, right? So a similar kind of, again, an analogy here is where what the regulators were expecting all these, after all these Lehman and other bank crises, what they realized is you can't just let one bank, big bank, okay, just kind of, okay, go bankrupt, because it's going to impact the entire system, because all of them are interrelated. So that's exactly where, okay, what they told is they wanted all these banks to stress test themselves. What does that mean? Okay, so that's when the CCAR, DFAS things came in. CCAR is Comprehensive Capital Analysis and Review. DFAS is Dodd-Frank Act for stress testing, right? Yeah. And then CECL is your current expected credit loss, right? Okay, so a lot of this, okay, have this flavor, yeah. But in essence, what is your stress testing is, you have like your BAU scenario where you will be able to, okay, ask to project how is, okay, what is going to be your capital numbers, and okay, you technically need, okay, run your PNL and other numbers, okay, all your models, etc., right, okay, across different factors, okay, which would be provided by the regulators, yeah. So as you see here, okay, if your GDP is normal, right, or your inflation rate has not peaked, right, okay, so then whatever you're predicting from these models and others, they're going to look plausible, right? But the problem comes in when there is an extraordinary event, okay, like a COVID, or there could be a scenario where, okay, interest rates drops, okay, too much, okay, it's going to impact some of your models as well, right? Okay, so there could be a lot of different events, right? That's when we used to model for CCAR, so we had like five scenarios. One is your baseline, you had your adverse, okay, severely adverse, right, okay, and then uh, right, the Fed also gave the advantage for some of these banks to come up with, okay, their own internal scenarios, because some of them add a lot of uniqueness, okay. Some of these banks had their own unique characteristics and so on, right? So in essence, they wanted for the next 9 quarters, part of CCAR, to stress test their entire portfolio, right? Which means then each one had to rerun their models. So they used to have their models, etc., for scoring and others, but then for your regulatory perspective, right, okay, they had to build a lot of models and keep them up to date, validate those models, they had to be audited, okay, and then they would get like a regulatory remediation, MRAs and MRAs, right? So I think that is exactly where, okay, you will see this team always busy and so on, right? So those are, okay, some of the areas where a lot of interesting and, okay, lot of complex work which gets done here, yeah. And IFRS 9, as you all know, it's an accounting standard, but this is where an accounting standard started merging with the world of financial risk analytics, right? So generally in accounts, as you see, the concept is, okay, they would look at loss only after a loss is incurred, right? Okay, whereas from an IFRS 9 and others, okay, that's when they realize you can't just wait for a loss only after it has happened, okay. So they wanted to look at, okay, what would be the expected loss or your future loss, right? So which is where, okay, there is a lot of concept of staging and others, and okay, right, you have to come up with, okay, what is this ECL, right? Yeah. So again, all of these, the models had to be unique and different, but there are a lot of overlaps. You could leverage some of your fundamental, your scorecards or your PT models and others, but again, okay, their objective will be different, and from an IFRS 9 perspective, you may need, okay, update it according to the requirements across those stages. Yeah. Okay, now that, okay, we're coming closer to, okay, so the I'll start taking Q&A as well. So like I promised at the start, right? So far we have been looking at the functional aspects, right, of credit risk. But in terms of tools and technology, these are some of the ones which are popularly used. I'm sure there are a lot of others, right? SAS is, okay, surely one of the top ones which is used across the globe across the Fortune 500 companies. Only thing given it is license and so on, which is where if you're already working, okay, you have a license, right? Okay, it's a very powerful tool. Okay, there are a lot of sub tools within SaaS like SaaS Enterprise Miner and so on. Okay, where you get like a lot of powerful capabilities. But now if you see, I know, okay, Pratik has been taking a lot of classes on Python as well, right? Okay, so you have got like a powerful all your Python library where you could do a lot of these data manipulation and modeling. And similarly, you could also leverage your open source R. Yeah, but having said that, okay, still lot of work, right? Lot of your exploratory analysis and others, cleanup and others. Okay, still you can Excel is very very powerful. Okay, even you could even run your linear regression, logistic regression, or even some kind of like optimization can also be done with Excel, right? Yeah, and your SQL or your what we have learned in math, right? Your Venn diagram concepts, right? Okay, because they would still be very very crucial. Okay, in a lot of these way you're applying when you're trying to build your credit risk analytics. Yeah. So again, I'm going to pause at this juncture, right? Okay, before I jump in. So now we are close to like 40 minutes into the session. Yeah. So do you guys have any questions? And given, okay, some of you are already experienced, some of you are new. Um, uh, so did you learn something new, or okay, do you have anything specific which you want me to okay deep dive on?
So I would like to chime in and say that and this is like a message to everyone that the pace was something maybe it might be a bit high for someone who is really new to the
Yeah.
field, because the objective of this session was to cover most of the topics and if not deep dive, but yeah, give a high level overview of those topics. And the only way to do that was to just maintain a bit of a pace, right? So that's the idea, and that's why, like, if you have any doubts, I think this is the right time to come forward and ask those doubts. I guess we are good.
Sure. And some of you were asking me, and I know, okay, I know there are a lot of people who are also running like, okay, a lot of these sessions as well. So if you see, I used to travel to a lot of client locations where do a lot of workshops on scorecard modeling, right? Because I still love that, because that's like your bread and butter, right? Okay, in terms of understanding credit risk. Because scorecard, like given like in India we all follow cricket, right? Okay, it's a very 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 simple and a powerful tool where, okay, you sum up all those individual batsman scores, you're going to get like the overall India score, right? Okay, similar to that, right? Okay, for each and every applicant, okay, you're going to get like what is their overall score across different characteristics. But there is a lot of math and, okay, finance and risk analytics involved there, and based on which, okay, the banks used to, okay, leverage it for their credit decisioning. Yeah. So if some of you, okay, who are already not working or not familiar, if in case you want to get into any of these advanced end-to-end scorecard development, right? Okay, I've done sessions on revenue scorecards, collection scorecards, right? Okay, and similarly specific things on, okay, like your Basel model development or CCAR and others, right? Okay, we could kind of, okay, do these um, uh, offline or separately. Okay, you can reach out to us. Yeah. So we could do that like Pratik mentioned, right? It's very difficult, okay, to cover all of these in like a webinar, right? Okay, which is just for an hour, right? Yeah. So the objective of this webinar was to introduce you all to, okay, what are the different areas, and a lot of these are, okay, live areas where I've actually worked on, right? Okay, so it's not just something which I'm just, okay, saying something, right? Yeah. And so again, okay, so which is where if you want to learn end-to-end scorecard, or, okay, it could be others. So even before that, okay, you should start with what is your banking book, okay, an overview of credit risk, understanding this customer life cycle in detail, right? Okay, and then like I mentioned, there are various scorecards like application origination, your behavior scorecards, okay, the way you develop it is, right, you will have like 600 characteristics in a library. Okay, you will have like the most beautiful math and coding algorithm you'll use to create all different variables and ratio variables from payment to balance, and, okay, delinquency in the last 6 months, right, max a lot of different beautiful things, right? Similarly, collections recoveries, okay, have a lot of unique elements given here. You have to predict and identify if anyone is going to kind of, okay, churn or, okay, not payback, right? Yeah. Right. So and then, okay, how do you build your entire scorecard, right? Okay. Leveraging some of these tools. And apart from this is where, okay, yeah, mainly in an application scorecard, you have this concept called reject inference, right? Again, that's like a secret sauce which a lot of these, okay, bureaus and others will have, right? Yeah. So this is how, right, okay, you have like your end-to-end scorecard. But even beyond that, okay, what I wanted to highlight to you is, see, a lot of these have been there, okay, for last 10 years and so on. But the one thing is, okay, with regulations, okay, there is always changes. That's exactly where we all need to adapt and others, right? And one thing I've done a full course for, okay, a fintech for a B school, okay. I don't know if some of my students are there here on this session, right? So if you see, now there are a lot of fintech companies is open, and mainly on a there is a specific thing called lending tech, right? Okay. So that's where there is something called peer-to-peer lending, right? Okay. And then you got like players like lending card, okay. So you see the second pillar, right? So you got like lending card, okay, you got like patience, capital float, and so on. So in terms of, again, from a career opportunities, right, apart from your normal Indian banks and, okay, your global GCCs, consulting firms like Big Fours, right, where you will get opportunities for credit risk analytics. But other than that, okay, the fintech players, okay, given they are new in the market, okay, they want to leverage a lot of alternate data. They want to do a lot of SME lending, okay, with the advent of UPA and others, right? Okay. So there is a lot of, okay, technology advancement which has happened here, right? So that's exactly where there is a lot of opportunities for, okay, here across the space, right? Okay, where you can leverage your credit risk analytics. And again,
Actually,
yeah, I'll pause here. Sure.
sorry to interrupt. Actually,
No, sure, sure.
we have got couple of questions, one from Sati and one from Shamla.
Okay, sure.
So
Okay, let me take it.
yeah.
Great. Okay. So, what will be the scope of credit analysis after years with once again? So, Swati, this is the first question, right? Okay, I'll start with
Yes, yes.
her. Could you talk about what skills are required for credit risk jobs if a person has experience in operation? Yeah, great, Swati. Yeah. So, okay, let me also leverage my next slide if it has something. Yeah. See, this is something, okay, as a finance or a risk person, right? So I know you can be in a banking operations, or, okay, or you might be in sales and others, right? But if you at least have a very good the analytical bent of mind, okay, and then you love risk and so on, right? Yeah. So what you can do, like I mentioned, okay, you need to kind of, okay, at least strengthen yourself in at least one of those three areas which I mentioned, right? Which is developing a risk domain expertise, right? And then have a little bit of, okay, build your coding knowledge, and then learn, okay, different analytical techniques, right? Yeah. So how can you, okay, develop in terms of your risk and finance domain knowledge, right? Yeah. So this is where, okay, beyond your MBA and others, right, that's exactly where yeah, you need to follow, okay, look at lot of these, okay, just don't follow just the LinkedIn post, but go to some of these regulators websites, right? So FRB publishes a lot of their okay, latest regulatory updates, okay, you can sign up for those. Similarly, RBI will be publishing a lot of their white papers, yeah. Similarly, your European Banking Authority and others, yeah. Got it. So start reading up on those. Initially it might look very tough, but, okay, at least you'll start understanding a lot of these technical terms, yeah. And then you have got a lot of website like BCBS, which is Banking and Capital Board supervisory websites, right? Okay, where you can go look at the Basel Accord. Yeah. See, some of these might be a little bit advanced, but, okay, I'm just giving it to for all of your benefits. But to start with, okay, at least you should at least know some of these products, right? How does a loan work? Yeah. How does even a credit card work? Okay, because I took a very detailed session, okay, for some of my MBA students, because many of us would be using a credit card, but we may not know what are the different revenue drivers and expense drivers on a credit card, right? Okay. So that's where you need to learn in operations, right? Okay. You might be knowing about, okay, how should a credit card be open, what is a KYC and others, right? Okay. But like, can you go a little bit more, open up your credit card, look at, okay, there is something called a most important document, right? Okay. There you will see in terms of, okay, what is a revolver, who's a revolver and a credit card, who's a transactor. Yeah. So again, okay, I'm just getting into some of these details, but yeah. So as a
So
fresher, right, okay, learn some of these fundamentals, right? And then build your expertise in some of these areas. I think that's exactly where if you are trying to, okay, some of you mentioned, okay, you're already taking these certifications, which will be very helpful. If you get across, okay, there are a lot of materials on financial risk analytics, or if you get a very good mentor or a coach who can help you in some of these, okay, do leverage their experience if you want to scale this up fast, right? So these are
Uh,
some of the things which you can do. Yeah. So I'll
Peru,
pass.
Peru, I have one more, to
Sure,
add
sure.
on to this is do you, how much, so for example, I have interviewed quite a lot of people as manager, and then I see, for same people with the same skill set, CV matters a lot. How
Yeah.
they put up things in their CV. So do you think like there is a way, for example, certain things that must be displayed in terms of technical skills that you said, or there are SAS, specifically for creators, right? So, to what extent do you think a person should spend time on creating their CVs and curating it really well? Because I have seen a lot of the CVs where either people have not either spent time, or they have taken help from those agencies professional CV agencies, which are not related to risk management. So they will make a very beautiful design, sort of
Yeah.
colorful CVs, but for someone when they apply with that CV, it looks very confusing. Because there are multiple points, and the person who would be interviewing gets confused, right? So, what is your say on that CV? How much role does a good CV plays in credit risk in particular here, but in general in risk management?
Yeah, totally agree with you, Pratik. Right? See, that's exactly where uh, I know many people, okay, just throw a lot of advice, okay, just you pick up keywords and, okay, try to, okay, just forcefully fit it in, right? See,
Yes.
but see, I've done a lot of interviews and so on, right? Okay, people will be able to make it out, right? Okay, but
Yeah.
that's exactly where, okay, so what you can do is, okay, you could do some. So there is a lot of, okay, open data which is available, okay, where you could leverage that, okay, even with a normal Excel with some plugins, right? Okay, if you know how to run a linear regression model or a logistic regression model, right? Okay, if in case you start doing some hands-on, even an exploratory data analysis, or, okay, or a little bit of, okay, like any models and others, right? And then you can kind of, okay, uh, try to see what are the latest regulatory challenges which a particular bank or an industry is facing, and if we are able to align to that, right? Okay, and then that's exactly where, okay, if you get some mentorship and so on, right, if you are able to, okay, do some of those and, okay, put those in your CVs, right, you can kind of, okay, divert the interviewer, okay, towards asking you questions towards that, rather than, okay, if in case you're already working in operations, right, your CV will have more of operations. Yeah, people are
Mhm.
going to just look at that and, okay, kind of maybe not go through, right? But rather, if you have something which you have done something, even from a learning perspective, right? Okay,
Yeah.
yeah,
Got it.
sure.
Got it. Got it.
Got it.
Got
Yeah.
it. Yeah.
Yeah, thanks, Pratik. Okay,
Yeah.
I think I'll take Shamla's question as well. So,
Yes.
Shamla, you're talking of scope of credit analysis. Okay, see, there is a difference between credit analysis and credit analytics. I'm assuming you're talking of credit analytics only, right? Okay, yeah, because credit analysis is where, yeah, there may not be that much of modeling and others, but it'll still be, okay. You'll use a lot of financial modeling. Okay, how do you underwrite? Okay, like the way all these corporates and others do, right? That is the realm of credit analysis. But even credit analytics, right? That's a beautiful question. See, I've built these models 10, 15 years back, right? Okay, but I still see a lot of them are existent today as well, right? And someone has also asked me, okay, with all this advent of AI and machine learning, okay, how will this change, right? See, I've even built a neural network model for a Japanese client, okay, yeah, and so on. But having said that, okay, I've done a revenue scorecard with a normal revenue scorecard, right? Okay, with logistic regression model and also neural network model, yeah. But the logistic regression model was, okay, much more powerful and easy to explain, right? Okay, you'll be able to understand this scorecard much better than a neural network, which is a black box. See, having said that, okay, obviously machine learning has a lot of these advantages and others which you need to leverage, right? But at the same time, right, regulators, the way they are moving in, right, even towards a Basel Endgame, or the way they are moving in is they don't want a lot of these black boxes and create like layman kind of scenarios, right? Because you kind of, okay, cover up a lot of your complexities inside, then it's no more transparent, right? Okay, then you are not able to mitigate your risk, right? So having said that, okay, see, there is a lot of machine learning and okay, AI techniques, right? Okay, which you can leverage, right? Okay, so many times we try to run like a champion challenger model where okay, you might have an existing logistic regression model, but rather you can even run a machine learning model and then try to say, okay, if that scores better or your objective is fulfilled, you can leverage the other model as well, right? Okay, so there are a lot of scope for okay, AI in machine learning is used in your credit scoring and others. Yeah, but having said that, okay, uh, you as a modeler or an analyst, you should also, that's where is the fun, right? Okay, the art and science element comes in. You should know okay what kind of okay like variables which you are choosing in, right? So because generally okay, after even though we will build a model, we used to go to our clients for delivering the model, right? Okay, we used to call it as weights engineering meeting. So even though we will know that okay, these are the 10 of 12 variables which are going to come predictive, but during the live meeting, client might prefer okay, no, I need this particular food group variable because okay, that will give us a little bit of different additional perspective, right? Okay, we'll kind of add that and show on if in case it comes predictive, we'll kind of add that in, right? See, that's where again okay, modeling is both art and science, right? So you should balance both and keep it. Yeah. um yeah, see, and like I mentioned, okay, even though all these advancements are coming, you will still have okay, a lot more scope on others. Okay, see, the good thing is here is right, even if you don't know coding, right? Okay, you can leverage a lot of your AI tools and others to kind of okay, at least come up with your basic script. Yeah, and then you can leverage it in the right way and kind of okay, customize your script. Okay, that way it's going to be an advantage, okay, if some of you are coming in, right? Yeah, but that's where okay, you still need to focus on your fundamentals, right? And don't worry that okay, whether AI will take this job, because with the advent of AI and others like I mentioned, right? With, so your fintechs are also growing, right? So which means you will leverage these on new kinds of data like alternate data, right? Like your mobile data or okay, or it could be some social security data, right? Okay, you will build some new models using machine learning or like big data, right? Okay, where it's no more a structured data, right? Okay, because you leverage a lot of your social media analytics as well, right? Yeah, so all of those would come in. Yeah.
So, Piru, I
uh,
would also like to
sure.
add, my thoughts on this because this is something even I have been asked, with advent of AI, ML, and growth in tech, will risk management, jobs, or growth in general, will it slow down or the jobs will start to slow? So, I would say, what happens with the tech advancement is actually it grows more, number of jobs or something. Like, if you're good with the fundamentals, as you just pointed out, right? So, your scope of work will actually increase. It may not have the same shape and form like as we see it today because it may change and certainly will get impacted by AI machine learning. But I don't think it's certainly it is not going to go away anywhere, right? Because credit risk
Exactly.
is so fundamental in nature, in banking. So I think it will stay. I agree with you.
Pratik, I see Kailash, given he has experience, right? He has experience in market and liquidity risk, and so he's
Yes.
asking, I need to add upon some skills. Which tool will be best? Pratik, you want to take it, or do you want me to address it?
So here experience in market and liquidity risk and need to add up on some skills. Which tool will be best for all the risk? If by tool you mean any programming language, so see, I think Python you should go because since you're already working on market and liquidity, so I am expecting that you have already worked on that, so you can when you're building credit risk models, so you'll be able to build regression models, linear logistic, and other models. So you can build credit risk models and interpret them well, and then gradually you can make a transition to maybe R. Like if you can find R models, they are also better. SaaS, it depends on your firm. If they are using SaaS, then sometimes what happens, like few firms, they are very specific on some platforms. So if they are using SaaS, so then you will have no choice but to use that, right? But I would again go with the idea that Theru highlighted. It's about understanding the fundamental concepts first, like you get, okay, what the model is trying to do, like PD, LGD, EAD, if a regression is happening in a particular manner, why these which variables are considered, right? Yeah, which of the macroeconomic variables are playing a crucial role or something like that. Basically, you understand the model, what it is trying to do, and then the tool part is just for implementation, right?
Yeah, my LinkedIn name is there, and also okay. I already gave one of my email ID. There's also one more, right? Okay, which you can leverage. But I think there is also this other question on CCR, which is
Yeah,
counterparty credit risk, right?
yeah,
So, like I highlighted, that's a trading book
yeah,
thing.
yeah,
I think someone was asking, okay, is it going to come on market risk or credit risk
yeah.
profile?
Yeah. So, see, this is so if you go by, let's say, conventional definition or something like, so it is by definition, it comes under credit risk, right? Because it's counterparty credit risk. When you're speaking about default, so then you are essentially speaking to CCR, right? But before default, like, there will be change in credit worthiness because of the market factors, and that affects the MTM values, which is captured by CVA risk, which comes in your trade, like. Trading book and market risk component, right? Uh, Typically, what happens, the kind of skill sets and models that are used for market this counterparty credit risk modeling, they are more closely aligned with, like, with like, for example, simulation techniques and all those skill sets which are used in market risk. So that's why when people are working on CBA desk or jobs, or like, they're recruiting for such roles, so they want to support, build that team in tandem with or in support with market risk team, right? As a concept, it is part of credit risk. Like, even in people who have done FRM too, they will see like entire counterparty credit risk. It is covered under credit risk book, right? So theoretically, it's part of credit risk book, is what I would say.
Yeah. Um, Thanks.
Hey, Watermelon, yes, there will be recording. We'll perhaps figure out a way like how to. I don't know if we'll be able to access it later, but if not, so then we will see if we can upload it on YouTube or something. If that is okay, we'll figure it out.
Sure. Yeah.
Pero I
Yeah.
think we're
And
just on time. Yeah, yes,
yeah,
you
yeah.
want to.
Good. Okay.
Yeah.
See, guys, I had a lot more slides as well. Okay. And then that's where, like Pratik mentioned, right? We wanted to not overload you on a Saturday, right? Try to, okay, but still wanted to give you a broader holistic overview. Uh, yeah, but it is surely uh, see, a lot of us have a lot of this industry knowledge, right? Okay, um, you could leverage it. Okay, so feel free to reach out, right? Okay, I know Pratik has a great community. Okay, so do post your doubts there as well. Yeah, so if any of us know some of these, okay, we'll kind of okay pitching in. So that's where we all can share information in this particular area. And to some of you, right, okay, who are doing your FRMs, and similarly people who are not in these roles, right? So you can surely, okay, plan yourself towards a career towards this if you're interested, right? Okay, if you're really keen, because it's a very beautiful career. Okay, you'll just love and enjoy it, and there are a lot of opportunities which are available. Yeah. Sure. So Pooja, you're asking about Udemy and others. See, there are a lot of things which are available. See, but I'm just being honest, right? Okay, spent 20 years, and same with Pratik, right? Lot of them are very generic, and you not get a lot of hands-on information. But surely, okay, there are a lot of courses where you'll get, like, surely, if you want to get a good overview on consumer banking, right? Okay, or at a high level, okay, a lot of those are available. Yeah, but that's exactly okay, like Pratik is mentioning. Yeah, so which is where, okay, we want to gauge your interest as well. If some of you want to learn some of these in detail, okay, yeah, so we'll kind of, okay, roll out some of these where it'll be a bit of deep dive sessions, right? Okay, and yeah, where you could come and we can run some workshops and so on. But surely online social media will have a lot of information. But what would be distinct here is these are you will get a lot of experience from a lot of live client case studies we have worked in. Obviously, will not be disclosing any of those names. It will be masked, right? Okay, but you'll be able to gather from these 20, 30 years of experience across all of us. Yeah, sure. Yeah,
So
thank you,
thanks.
Sai. Thank you, Swati. Yeah, thank you all.
Thanks a lot, Peru. Like, for like, finding out time for us and giving sharing your rich experience, your rich knowledge with us. And I
Yeah,
hope this was extremely helpful for community as well.
yeah,
And I can see like people want to learn, right? And
sure.
hopefully we can plan maybe one or two short courses, because like, there is, as you mentioned, like there is a lack of more relevant and more insightful courses out there in the other portals, and we see a gap there, right? So we'll try to fill that gap, maybe with some courses in the coming weeks and months, right? Okay, perfect.
Sure.
Yeah,
Okay. Thank you all. Have a good weekend. Thank you, Pratik, for the opportunity. Okay. Thank you all.
sure,
Bye.
you're welcome. Thanks everyone. Have a great weekend. Bye.